Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. Over the coming 48 hours of trading, we have a particularly dense round of event risks that can very well develop a lot of volatility for certain currencies, maybe even some broader fundamental themes. That means a lot of price action potentially. However, as we've been discussing in previous videos and webinars, the opportunities for a bullish or bearish quote-unquote outcome from this data is very different. All right, the impact can be very different, and that's because of an imbalance of opportunities and a pre-positioning of the markets. Now, I know that's kind of a vague term, so I wanted to spend today's strategy video looking at a couple of these events and looking at how we can look at this potential versus probability. All right, now potential versus probability. For many, this seems like the same thing, but indeed, they are different. All right, now potential versus probability, I think one of the most straightforward ways of illustrating the difference here is using the example of the lottery. The lottery, most of you should be familiar with, the probabilities of winning this, and this is according to the Powerball that just put through in the United States, and that was through the end of this past year. It was at one point, 1 in 259 million chance of winning. All right, now as you can see, that is a 0.0000004% chance of winning something, or winning the lottery. Now, of course, the outcome, the payout would be $648 million, which would have been incredible. But you have such a low probability of getting it that the probability and potential don't necessarily balance out. Now, we can see something on the exact opposite end of that spectrum. All right. How about treasuries? The probability to get my money back and I get a high rate or get a rate of return that they promised me, 99.9%. It could be potentially higher than that. I didn't actually calculate statistically. But the potential, however, of investing in a 10-year treasury is a yield of 2.55%. Not a very high return. High probability, but not a very high return. Now, what traders do and what the markets do when they speculate is to see and find a balance between the probability of certain outcomes versus the potential return of those outcomes. All right. Now, we have seen a lot of this conversation in terms of potential, and we will see through some of the event risk in just a second, but I think a good illustration in the market's sense is something like the S&P 500. What's the probability that we continue higher in the S&P 500, one of the most expensive and theoretically overbought of the equity indexes in the world? Well, considering that we're in a 5+ year bull trend, the probability of a continuation to the upside is higher. But the potential of having more participants, more volume behind a continuation so you can get in now and sell at a higher rate, let's say months or years down the line, is lower. All right, the potential of the payout is probably going to be smaller. All right, but the probability is fantastic, relatively speaking. So when we see these types of conditions, we can definitely evaluate from a fundamental perspective, but a lot of this is qualitative. It's not necessarily quantitative, and we have to be sensitive to the fundamental developments as they come. Now, I could perform this kind of potential versus probability analysis on a number of event risks over the coming week, but I'm going to really isolate it to two pieces of event risk specifically, and that is the UK inflation figures and Fed Chair Janet Yellen's semi-annual testimony before the Senate Banking Committee. So what do we look at when we are looking at those events? Well, first let's start with the UK inflation figures. What's the cost here? What's the potential? Well, there are two potential outcomes from this CPI data. And we know how important it is because we've watched the pound and the pound dollar really trace out very specifically a bearing that has a lot to do with those rate forecasts. Here's the UK versus US 2-year yield differential versus the pound dollar. There's a lot of interest rate forecasting going on here, and it's very much one of the benchmark drivers for this currency and this currency pair. So what is the potential here? You've seen a big run here. We've seen a big run up on interest rate expectations. So what's the potential versus probability? Well, the probability that the data comes out to be, let's say, hawkish or an upgrade in those rate forecasts, a higher probability because we've actually seen the data has shown improvement, not necessarily inflation, but the impact of that data is a little bit more substantial. All right, and a little bit more consistent. We look at other economic forecasts, we look at the market's skepticism for any downturn, and of course the Bank of England's commentary. So the probability that it comes out to be hawkish or support, or at least keep unchanged, the sterling's rate forecast is high, 80%, I would put it at. The potential, however, for the pound to fall through is probably pretty low. Right? Modest pound advance. Why? Well, because in these interest rate forecasts, you can see that we're already pretty exceptionally high. The assessment of the Bank of England in being a hawkish policy maker is already very substantial. It's at the very hawkish end of the spectrum. So there isn't much room for it to continue higher at a rapid pace. It could definitely continue higher, but not rapidly. And that's only if we had a substantial upgrade for those interest rate forecasts or the pace would be more aggressive. And that's very, very, very difficult to imagine coming through in the data and through the financial markets that we have today. All right, so we have an imbalance of opportunity. Now, what about a downgrade or dovish data? Probability is relatively low, and the market responding to dovish data is lower. We've seen a little bit more resilience to that. But if it is substantially lower, considering how important it is, how aggressive the Bank of England's interest rate forecast is already priced into the market, when we look at where it's at on the spectrum, or where we see where the rate forecasting has really leveraged the pound to in its recent 12-month run, we know that there is a lot of unwinding that can be done. So that's a really high potential for the sterling to drop, even though it's a low probability. All right, so it's an imbalance that we have of opportunities amongst the scenarios. So which one to position for? Well, that depends on how finely tuned do you think that the return potential is versus the risk potential. In general, I don't think that this is straightforward enough that I'd be willing to just take a preemptive trade. You have to be really confident of either the outcome or actually the potential. All right, the rate of return that you can get, the big movement that you would expect after a move or a surprise in your favor. And that balance, that combination has to be there. Otherwise, it's not worth trying to jump in ahead of the game. And after the game, after you get confirmation, you have a little bit more ability, a little bit better ability to evaluate and see if it really does have follow-through potential. How about another piece of event risk? What else is important? Janet Yellen, the Fed chairwoman, is going to give her semi-annual testimony to the Senate on Tuesday. She's going to give it to the House on Wednesday. A lot of things can be discussed here, including the outlook for U.S. interest rates and whether they're going to maintain their pace of taper, what can accelerate, what can curb them, whether the economy is running fast enough for them to pull back from their accommodation, whether they are stifling economic growth and potentially building up financial bubbles. A lot can be discussed here, a lot. All right, but let's break it down into some pretty basic terms. How can this U.S. interest rate speculation that evolves from this event really be evaluated? All right, well, let's say an upgrade. Let's say it becomes hawkish. If there's hawkish commentary. The probability of this actually occurring is about 40% in my book. Balance that out. 40%. Why is it so low? Well, because an upgrade, a hawkish discussion from the Fed, they've been very dovish and reticent, and though they've talked taper, they try to talk it down. All right. Now, this can have a big dollar impact, however, versus a kind of dovish commentary, where the probability is higher, 60%, but the impact is smaller on the dollar. Why is that? Well, let's look at how the market's positioned for this kind of outcome. All right, and we'll see how the imbalance can be visualized. Here we have the Fed Fund futures. All right, we've been tracking these, and this is where the market expects the interest rate to be at the end of 2015, and the interest rate to be at the end of 2016. However, we know that the Fed's own forecasts are up here and here for the respective years. So there is a big discount. It's kind of difficult to disappoint even further, to move even further down from those interest rate expectations. I mean, it's not possible. But we're already substantially cheaper than what the Fed is itself projecting. to disappoint here, yes, it would weigh on the U.S. dollar, but realistically, it probably wouldn't have that much further impact. We would probably see maybe a break to the downside on this, but you'd have to really see a disappointing commentary from Yellen, or a very dovish commentary from Yellen, which would deviate from her normal signals to see the dollar really take a tumble. Alternatively, more of the status quo is steadily and steadily and steadily getting more to the point where status quo is actually bullish for the dollar, because we are under those forecasts. So here too, there is an imbalance that is actually building with time for the interest rate forecast for the US dollar. And perhaps one of the biggest themes that we have to keep track of, and we started off actually talking about it with the S&P 500, what happens with risk trends. All right, so we have a full docket this week. What happens if this data stirs or spurs risk on or risk off type sentiment? All right. Well, let's take it into consideration. The S&P 500, just off a record high, has been running for 5 years. Economic activity is steady, but not necessarily robust. Certainly not of past decades. And we've definitely priced in a lot of optimism to this point. I think many can argue, and argue well, that we are pricing close to perfection with where we're at. So the probability that we maintain this 5-year run on the S&P 500 as a measure of risk is 90%, because it's a very robust, very consistent trend. However, the follow-through is probably going to be relatively mild, because we are already well positioned for risk on. Alternatively, we are terribly positioned for risk off. A low probability indeed, but if it does kick in, we know how remarkably the risk spectrum is positioned. All right, so when we look at the volatility index versus the S&P 500, we can see that the volatility measures are extremely low, and the S&P 500 at a record high. It means that there's very little premium for risk behind these markets. All right, so the impact could be quite substantial on a negative outcome, or on a bearish outcome. And it's not just for the S&P 500, although that is perhaps one of the best effigies of risk theme and how exposed it is. We also have measures of risk that include the yen crosses in the FX world. So we can look at the dollar yen, which is definitely a good one, the euro yen, which is a great one, pound yen, even the higher yielding currencies like the Kiwi yen, depending on how risk averse we get. And even the euro dollar has a risk tone to it. It is sensitive. In fact, it's probably more sensitive now to risk on, risk off than it has been at any time in the past. All right. If you want to know why, I discussed that more heavily last week in one of the strategy videos related to the euro. So we can look at different themes, we can look at different scenarios, but assess those scenarios for their probability of outcome versus their potential for outcome. Sometimes the probability might be really, really high, but the return that you can make on that particular scenario might be so minuscule that's not even worth taking the trade. It's best looking elsewhere. And sometimes, while the return potential on something might be so significant, like the lottery, your likelihood of actually making a profitable trade might be far too low. All right? So we have to find a happy balance between those two. And there is no set rule or formula that says that this is or is not the right type of trade or the right type of balance between potential versus probability. You have to assess that for yourself and see what you're willing to take and what risk you're willing to absorb. All right, we'll wrap it up here. We'll do another strategy video tomorrow. Until then, good luck trading out there.